Emergency investor warning. Mr. PUTIN's goal is to crash the global bond market and dethrone the dollar. He is succeeding. On April 6th, we sold one half of our Boyle natural gas position, betting on hyperinflation causing the bond market to sell off viciously. And that first profit was for 139%. Now, again, the general problem with this invasion in Europe is that it's causing extreme inflation in energy and food. And we can see the UN food index is at record levels. There are riots erupting all over the world as people are now starving. We need to prepare to sell the second half of our Boyle position, the natural gas position, in late April or May. And now that position's up even more than when we sold the first half. And again, ignore the media. We are not winning this war. This is absolutely a disaster unfolding. We can see the ruble's already back to new record highs, and everyone is happy to buy their energy at a discount. What we should anticipate with the dollar is for it to go up until a complete crisis unfolds and then a major sell-off. And so that's when we're going to be locking in massive profits in cryptocurrencies, is when the dollar makes its move to the downside. Today, DXY is trading at 99.92. Now we can see, leading to the .com crash, DXY went all the way to 120, and then till 2008, sold off to the 70 level. And since then, since the inception of Bitcoin, the dollar's actually gone up in value, with Bitcoin returning 1,000,000%. So just imagine the profits we're going to be able to lock in on the next decline on the dollar, which I think is around the corner. We'll discuss the timing of this in this webinar. It's critical that all investors own 4 stocks to protect your wealth right now. We're going to review those 4 important positions. But how are we doing? Our year-to-date return is 35%. We're up to as much as 40% last week. We gave a little bit of that back, but just an outstanding total return. Now, again, that's not just a partial return on a few positions. That's the total return of the entire account for 2022 in our top selling high risk growth portfolio. Last year, this exact strategy returned 233%. That means every $10,000 invested grew to $33,000. Now, I've got bad news. The European conflicts may become far worse in April. There's absolutely no sign that this is going to get better in any way, shape, or form at this point. I see absolutely nothing on the horizon for diplomacy. So we need to basically stay put with our positioning until either we get an extreme spike in natural gas prices or there's diplomacy. And again, I just don't see the diplomacy around the corner. So let's walk you through a $10,000 trade alert right now. Step 1, buy 68 shares of UVXY today. UVXY is up 6.5%, which is nothing. This can go up over 1,000% in a month, and a 10% position in UVXY can completely protect your portfolio against major declines in the stock market. And so last lockdown in 2020, when oil went negative, people went bankrupt, stock market sold off 34% in a month. UVXY went up 1,100%. So again, 10% position, your other 90% of your portfolio could have gone to zero, and you're still up 10% at the peak panic. Here's a look at the UVXY. It's been up as high as 22 this year, sold off, and now it's making a little bit of a bounce back due to the bond market volatility. And so we rarely touch this position. It's there for absolute catastrophes. It's akin to health insurance or life insurance. You only want to use it when you absolutely need to. Step 2, buy 144 shares of TMF. This is a leveraged treasury position. Okay, so the whole goal, in my opinion, of the European conflict was not just to take over a strategic piece of land that controls much of the pipelines of natural gas into Europe. I believe the true goal was to create inflation and to create financial chaos in markets globally. And so bonds do not like inflation. And now we have very sticky energy and food inflation, which is further deteriorating the US bond market. Now we're at a level today where the interest rates are so high, I believe they can start to become extremely problematic for competing markets. So we relate this to something like a black hole that's going to gobble up everything around it until it's satisfied. So we'll look at some charts on treasuries, but right now we are building into a TMF position. We're very close to a level where I would increase this position even further. And we're going to look at a lot of charts of bonds and why they have to go lower over time as debt grows. But TMF is a 3 times play on the 20-year treasury. Now, bonds have a great track record of performing a positive return. Okay, so the current drawdown in the US bond market is historical. Not only is it one of the greatest declines in the bond market in such a short period of time, it's been going down for 2 years. If you look at this chart, you can see there's never been 2-year stretch of this magnitude. So we're very close to essentially, most likely, extremely positive returns on bonds. Here's another table looking at this bond market correction. And I want to point out, Portfolio Builder has been a huge fan of bonds until we went into quantitative easing. And that's actually how we made a really nice return in 2020 when the stock market crashed, because we're betting big on bonds and had been since the conception of this newsletter. But once we went into massive money printing, we knew this would be negative for bonds. We're now weeks away from going from quantitative easing, which is negative for bonds, into quantitative tightening, which is going to end up being very bullish for bonds. So if we look at this, the 9% decline over 609 days, which is now extended, is a record both on the percent decline and the number of days that the market's been down. So unless we think we're heading towards worse and worse inflation, and that the bond market's going to completely collapse and that central bankers are going to allow this to happen, we're very likely at the very bottom of this correction in bonds. So we're building into the position last week, expect to sell BOIL and most likely double down on TMF in the near future. I'm talking probably within 8 weeks, maybe even less. Now, if there's diplomacy, we know we'd rather go into tech stocks because that's going to fix the supply chains. And there's some other things happening in supply chains that's very worrisome in China with extreme lockdowns. Here's another look at the TLT declines from the highs. And you can see this is just extraordinary bloodbath in the bond market. With $300 trillion of global debt, these interest rates are not going to stay at this level. Absolutely not. Now, step 3 is to buy 170 shares of ETHE. This is the Grayscale Trust that gives you exposure to Ethereum from your stock account. This is the operating system to design software. It's like buying Windows or Microsoft when it was 5 years old. This has decades to reach its premium pricing and market cap. And if you got in from day one, you're up 21,000%. We've just had a 50% correction, and now is an absolutely beautiful time to begin building into your ETHE Grayscale Trust Ethereum play. Now, what's been really successful for Ethereum so far is 2 platforms. One is Aave, which is now allowing people to borrow without credit checks. All you need to do is post your collateral, take out loans. We have a private equity company that's utilizing Aave. There's $30 billion of collateral there, and you can take out a massive loan, about 80% of your collateral, at a 3% interest rate with $1 origination fee in minutes. Okay, so that is replacing the US banking and loan system. Banks are now banning us from wiring money to Coinbase. They are freaking out. It is remarkable. It's growing rapidly. It's growing faster than the internet. The other thing they've done is Uniswap, a top 20 cryptocurrency. This is replacing what Coinbase does. It's a decentralized exchange. And then furthermore, the NFT is the other big story. Plus, they have some gaming apps coming out. More importantly, Ethereum's about to switch to proof of stake and really give some of its recent competitors a run for their money. So those would be Cardano, Solana, and AVAX. All said, this is our favorite growth asset over the coming decades. I think you got to hold for about 2 to 3 decades to see this hit premium prices. And most likely this will become a very, very significant piece of world history. Step 4, buy 38 shares of Boyle. This is the natural gas from the US. We're trading at about 1/10 the cost of European natural gas right now. It's extraordinary. It's almost unfathomable to imagine natural gas prices going up tenfold in the US to catch up with Europe's. But essentially, that's what could happen. If Europe wants to stop buying natural gas from RUSSIA, or if Mr. PUTIN cuts off Europe as a military tactic, this is going to go straight up. So we've made a good return on it, way over 139% on the second half. We're holding on to it. And unless something gives, this is most likely going much, much higher. So this is our inflation hedge. This is our bond market hedge. This is our European conflict hedge. And it's been working extraordinarily well. Let's take a look at it in a table format. We have per $10,000, 68 shares of UVXY. That's, and again, I want you to note on the top, it says defense and offense in the middle. The defensive positions are deflationary. Okay, that means a slowdown in the economy. We're clearly entering a slowdown in the economy. And so this is the TMF for treasuries. This means yields are going to fall from here to make money. And then UVXY is if something breaks, if people start going negative, they're losing more money than they have, and they're forced to start liquidating assets. So we've had extreme change of price in commodities and bonds, and there could be people who are negative right now. They're going to start liquidating assets. If they all do it at once, this can create a domino cascading effect of selling pressure. So that's what UVXY is there for. Absolute black swan events. So that's your deflationary side of the portfolio. In total, right now, that's up to 33% of the total assets. On the offensive side, we are playing inflationary assets. And in general, if governments are going to spend more money than they make, these will go up over time. And there's zero chance that any government anywhere is going to run an account surplus anytime soon. We would truly need a revolution for anything of that nature to occur. So these are our long-term assets that we want to hold for decades to come. And the favorite one is Ethereum, which is down 50%. I have no expectation of selling any of this position anytime soon. Again, that's 170 shares representing 38% of the portfolio. Now, the position we do want to sell soon, and that's probably within 8 weeks or less, is Boyle. We already have oil selling off pretty rapidly. We have China locking down as if there's something insane happening. It's not clear why they're going so draconian. Right now, if you test positive in Shanghai, they rip you out of your house, kill your pets, and put you in a quarantine center. There's hundreds of millions shut down in China. So this is absolutely mind-boggling. I'm following this story closely. So I think our time to sell Boyle is running very soon. But we got to be careful because that's a big playing card for the war in Europe. So that's the way we're looking at the markets right now. If the war is going to escalate, we want to carefully sell Boyle and buy more treasuries and more UVXY. If the war is going to de-escalate, which again does not seem to be on the cards whatsoever. What we're going to want to do is, and again, if there is a miracle and there's diplomacy, we're going to sell Boyle and we're going to add FNGU for a leveraged tech play. And again, if there's diplomacy, we're going to get these supply chains fixed, which would be good for the tech giants because they need semiconductors, which are being backlogged. It now takes 34 weeks to get a chip. And the neon coming from Russia and Ukraine is critical in this process. So very, very, very interesting period of time coming up. The bond market's now on the verge of crashing the stock market. Here's a look at crises when interest rates go to these levels. We're above the trend. I find it extremely unlikely that yields go much higher than they are currently. So again, if things are going to crash, we want to add to TMF. If things are going to get fixed, we want to add to FNGU. And that's really the way we look at the market here. The proceeds to add to either position will be through Boyle. That's the one I see us selling soon. And so again, in general, for debt to grow, interest rates must go lower over time. Governments are spending more money than they make, so it's absolutely mission critical that yields do fall over time. So I believe we are very likely at peak interest rates here. Here's the TLT. Now, I was telling you guys, I was expecting the TLT to reach 120 maximum, and it would take 2 years. And lo and behold, we are sitting at 123 in April, only 4 months after we predicted the bond crash. So this is happening fast and furious. Tomorrow we get the new CPI. Psaki's coming out saying, get ready, it's going to be ugly. I believe we're going to have the worst inflation print of the year tomorrow, and then it will begin to fall in coming months. And that's because we went negative on oil 2 years ago in March, which is the CPI print we're going to get tomorrow. So the data will be very, very hard to keep rising beyond March, and that's going to be very good for the bond market. Now, again, the wild card is how long can they keep energy costs high, but thanks to China locking everything down, that is driving these energy costs lower. The 2-year starting to fall and the long end's rising. So this inverted yield curve, which was flattening the yield curve, is starting to steepen now. And it's the steepening that can lead to the recessions. So very interesting moves. Yields and energy prices cannot remain at this level. We can see oil in the past has gone above 100. Not for very long, okay, not for very long. It ends up with extreme volatility in markets, slows down the economy, and ends up crashing. So we need to get ready to sell that Boyle before it's too late. Now, the second the conflict ends, assuming it's with diplomacy, the play I like is FNGU. That is 12 tech stocks. Again, if yields go down, tech stocks tend to rocket ship higher. We've got a nice Ethereum plate. This would diversify the portfolio into the hottest tech companies in the world, 2 out of China and 10 in the US. Meanwhile, China is printing at rapid pace. Their economy has crashed and they're printing extremely fast as the US is entering a tightening cycle. The last time this occurred, Bitcoin did return 4,400%. The only difference from 2016 to 2018 is that we're dealing with 300% more inflation on the CPI, and they're talking about doing quantitative tightening and rate hikes. I want to point out it was in 2018 when they began quantitative tightening, and that's when Bitcoin actually fell off a cliff. Now, it's not necessarily that's what caused it. It could have just been interest rates got too high that it began collapsing assets. That's why it's critical you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. And if you don't want to miss out, call Dean to upgrade your free trial at 505-322-7515. All right, let's jump into the data here. But here's our returns for the high risk portfolio, 9.9% in January. We lost 3.6 in February, pulled a massive gain of 24% in March, currently up 1.86% in April. And that's our high risk portfolio, which gets on your free trial. Our safe growth portfolio Still outperforming the S&P 500 and the NASDAQ. It was positive last week, pulled back a little bit. This portfolio is as safe as it gets. It plays a global stock market, and it plays 4 different types of inflationary hard assets, from lithium to uranium, all the way to rare earth metals, and usually we have an oil position. So right now we pulled 1.5% in the safe growth. In January, we had a 6% drawdown in February, pulled a 1.6% return in March, and we're down 1% in April. Our recommended combo is to do 70% of your portfolio in the safe growth and 30% in the high risk and rebalance once a year, or excuse me, once a month. That strategy, when you combine them, is currently up 10% year to date, which is a good return considering how ugly the markets have been this year. And when you do upgrade, you'll gain access to the position calculator membership area, where you can simply punch in how much you want to invest and then hit calculate, and it tells you exactly what to buy or sell. Okay, so I'm going to go back to that at the end of the webinar. Let's jump into the data. I'll start off with the news feed, and then we'll go into charts. And I see a few, I'll hit questions towards the end too. Let me go through all the content, and then we'll go through all the questions. Okay, Jurian Timmer from Fidelity, essentially saying that the stock market is overvalued relative to these current interest rates. And so either the stock market's discounting how aggressive the Fed will do, and these rates are going to come down, or stocks need to go lower, is essentially what he's summarizing here. So disconnect between the Fed and the stock market based on where the 2-year yield is now at 2.5%. The forward PE ratio should be 15 times. Instead, it's at 19.5. This is an equity conundrum. A 4-point PE compression amounts to a 20% valuation haircut. The White House is now warning of extraordinarily elevated inflation data. This will be coming in tomorrow. And again, I believe it'll be peak inflation data. And we have our predictions on what it will do. We'll look at that in a moment. Jim Bianco says maybe we're already back to normal. Looking at some data, not everybody's going back to work, simply put. So we've got NBA games are at 93%, TSA checkpoints 87, open tables at 86, movie boxes are at 80. Cost of capital has risen dramatically as the Fed fights the inflation beast, but the earnings yield, which measures the cost of capital for equities, has barely budged. Equity investors perhaps are discounting how far the Fed will go in this cycle. And so that's really been the trend, that they talk a big talk and then deliver a little less, and the markets have been relatively happy. So the inflation and the CPI has to start falling, or else we do have problems. I believe that is the case. I'm still in the camp that I do think we will peak out in inflation, run hot and sticky until the war concludes, and then start to fall quite quickly. Zero Hedge says, there it is. Philadelphia reimposes indoor mask mandates. Alf says, rates can go up for good or bad reasons. This year, the entire move has been driven by bad reasons. Rates moving up, and this was fast, while the rate of economic growth is slowing, are merely a signal of increased risk premium due to abruptly tighter monetary policy. So we've got growth forecasts going extremely towards the negative side as the Fed is trying to hike rates. So this could be a disaster if they really follow through too aggressively. And we got to remember, we're heading into midterms this winter. So do they really want to send us into a stock market crash recession ahead of midterms? Port congestion is now 455 ships stuck waiting to get loaded up on the coast of China. RUSSI has threatened if Finland joins NATO, they will be attacked. Now there's news that Finland and Sweden are ready to join NATO as soon as this summer. Western media is trying to make it look like this is going in one favor when the reality does not seem to be that way whatsoever. So we'll just, it looks like both sides are ready to let this go for weeks longer before there'll be any sort of diplomacy. China lockdowns hammering the economy. Cases are skyrocketing. They're doing extreme lockdowns that were worse than March of 2020. And this should, in some respects, help get energy costs down, but it's going to create more snags on the supply chain. So we'll see how this impacts the CPI in the coming months. This is some data on the best performing markets when rate hikes began, and it's the NASDAQ, which is kind of counterintuitive. So if we're going to tighten policy, yields should fall and the NASDAQ should outperform. If we're going to loosen policy, rates should rise and the value sector, energy and commodities should outperform. And so that's what we're getting ready to do, is tighten. Here's a look at the credit rebound. China's response to lockdowns is brr, meaning let the money print. We can see trillions of yuan being printed to support their economy. Elon looks like he's going to do a hostile takeover of Twitter and try to defend free speech. Let me break this down for you. Elon became the largest shareholder for free speech. Elon was told to play nice and not speak freely, so then he turned down the board of directors position. Very comical here. The long view, why did rates fall recently? Primarily because the Treasury avoided $1 trillion in new issuance by spending the last few months. Also because macro guys were up to their eyeballs in short duration trades in an oversold market. Both are done now. Let's see what happens. He says, looks like we got our answer. So this was the account Treasury getting drained. Since then, Janet's been issuing massive amounts of debt and rates have been selling off viciously. And again, I think we've loaded up the Treasury with plenty of money and most likely rates are going to begin falling here. Peter Schiff says CNBC just aired a segment discussing the merits of government-imposed price controls to fight inflation. I predicted price controls were coming long before anyone on CNBC even knew inflation would be a problem. Not only did I see the problem coming, but the wrong solution too. Again, this will just disrupt the economy and create shortages. 51% of government receipts come from individual income taxes, but what's been growing is social insurance and retirement receipts. So again, you can just see how trapped the government is. This green section essentially has to be financed through debt. And so if rates rise too much, expect central banks to print money to suppress yields. The Hunter Biden story is unraveling quickly. This has been well known to pretty much everyone why the big media suppress this and put these guys into power may become more clear over the coming year. Here's a list of Elon Musk's proposals before quitting Twitter's board. Rename it to Titter, turn headquarters into a homeless shelter, eliminate ad revenue. Twitter is dying. He pointed out the top 10 Twitter accounts, and almost none of them tweet anything at all except himself. Overhaul the blue checkmark policy. Create an edit button. This guy is a character. Here's the CEO. A little note about Elon turning down the board position. Preston says there's a massive shock in economic markets brewing, and really soon that's going to cause central banks around the world to aggressively reverse course in their tightening talk. The 40-year trend line in bonds is breaking down and yield curve control in the US is right around the corner. 51% of German companies and warehousing are completely disrupted due to the lockdowns in China. The 10-year Treasury jumped above the 10-year Chinese government bond. This is going to draw massive amounts of money to US bonds. Lynn Alden says, I've generally been a bond bear, but the speed and magnitude of this move is surprising even to me. Same thing for inflation. I've been expecting and writing about inflation and then still surprised at how fast and hard it actually hit. Again, you can see it was one of the worst declines in the bond market in history. You have to go back to 87 to see levels of this magnitude. Lavrov, RUSSIA's special operation is designed to put an end to the US course of domination in the world. This is effectively a war between unipolarity and multipolarity. Shanghai is basically 100% closed down, subway passengers at 0. Quoth Raven says the COVID response in Shanghai is so insane and asinine, given how dangerous COVID is or really isn't. It's starting to feel like either one, the government is using COVID to implement Orwellian rules it had long planned, or perhaps just get energy costs lower. Or two, there's something different about this that VIRUS, they know and we don't yet. Here's a look at productivity. And again, we are losing relative productivity due to demographics. And now technology is not creating new jobs, it's just making humans worthless. So big problems for labor markets and governments. Here's people going crazy in China. They're starving, they're breaking the rules. Chai Girl says, we're still dealing with supply chain issues from lockdowns 2 years ago. New lockdowns just poured gasoline on that fire. We got a little Zelensky doing a photo op here in a 60 Minutes interview. In the middle of a war, very interesting. Okay, so I think that covers the best headlines over the last 24 hours. All right, let's look at the markets now. So here's your bond markets. Again, you can see rates can go up sharply, but then they quickly reverse and crash everything around it. So we're there, we're right there. So again, if we're gonna have the European conflict get worse and energy costs spike, then we need to bet on a crash. We need to get out of stocks, cryptos, everything. Only thing that makes sense is the dollar, the bond market, and the UVXY. On the other hand, if we're gonna get energy costs down, however it happens, then I would want to bet on the NASDAQ and supply chains getting fixed up and that we're not about to crash markets. But yeah, these bonds are at extreme levels. And I think we're very close to needing to sell out of all of the inflation bond market hedges, which would be your oil and gas or your natural gas plays, and bet on either an outright crash in everything or the tech stocks and cryptocurrencies rocket shipping higher. Here's your TLT, same data. You can just see these trend lines. We're there. This is very dangerous levels, highly unlikely. The TLT goes below 120 without causing severe damage to markets and freaking out the Federal Reserve. Here's a look at interest rates on mortgages. Half the global debt is in the housing market, and Again, this would be devastating to global markets for these rates to go any higher. So we're at a very critical moment here. Here's the 10 and 2-year constant maturity spread. So it inverted. Now the 3 and 10-year has not. So that's very important. The 3-month over 10-year is signaling we're early cycle, while this is signaling we're late cycle. So big divergence in those two signals. But in general, if we see the 2-year fall viciously and the 10-year either stay at this level or go up, that could be signaling a recession incoming. Right now, it's not doing that, but it did slightly invert. I'll go back to that 1 year. So it tiptoed under there for a quick second. Here's a look at the yield curve. So this is the 3-month. Again, this one is nowhere near being inverted. There's a massive spread of 2%, 2.1%. The 7 years over the 10-year currently, and the 20 years over the 30-year. We have seen the 3 and 5-year go over the 10-year for short periods of time. So problems in the bond market. The futures market is predicting we will have a 50 basis point rate hike in May. This is priced in. And the FOMC minutes said they're going to start selling $95 billion of treasuries per month. And this is while we're issuing massive amounts of debt. So the market has priced that in, I believe. And unless there's something greater than that, I believe the market be very happy with the Fed's announcement in May. And so we'll see what that CPI comes in with tomorrow. Here's your VIX futures term structure. We're seeing the biggest jumps in April and May. Again, markets are nervous about rate hikes and quantitative tightening into a slowing economy with conflicts in Europe, supply chain disruptions in China, and all sorts of problems. Reverse repo still has $1.7 trillion sitting in it. This is a QE buffer. Gold and silver ratio, they call it Dr. Copper, not making any type of prediction. This is not predicting higher or lower rates. If gold is moving up faster than copper, it's predicting lower yields. If copper is going up faster than gold, it predicts higher yields. Right now, not giving us a signal. This is comparing NRGU to BOIL, our two favorite plays. In this time frame, BOIL is smoking NRGU, up 171% compared to NRGU up 79%. So we'll sell BOIL soon, and at the right time, we'll get back into NRGU. So great job for everybody who played on BOIL. Lumber futures still at very expensive prices, but not as high as May of last year, not as low as August of last year, but currently weakening. So the signs are that we're headed towards a slowdown, which means lower yields. So we're lucky to have the one inflation hedge that's still up, BOIL, as oil and lumber futures are falling currently. Here's your dollar index. In general, I'm expecting the dollar spike until energy costs fall, and then for it to fall. And that's when I expect us to make massive amounts of money in the NASDAQ and Ethereum. If you're in the safe growth, it's going to be Bitcoin and stocks. Chinese currency, we're watching for a massive devaluation as their economy struggles. So far, it's ultra strong. Nothing to freak out there. These are our favorite growth assets. One of which you can't play in the stock market, Polygon, ticker MATIC. You can get exposure to that with our private equity offering, only available to paid members. Call Dean to learn about that. So that's our favorite. It's going to be the most volatile. You're going to lose the most on the downside. You're going to make the most on the upside. This is what's going to make Ethereum extremely fast and cost efficient. It's like the Lightning Network for Bitcoin. It's got 1/30th the market cap of Ethereum. It can greatly outperform Ethereum over the coming years. Our next favorite play is obviously Ethereum. That's like investing in Microsoft when it was 5 years old. It's an operating system to design software for decentralized applications. And it already has 3 massive success stories, and it's just getting started. It's going to take decades to really reach full market cap, and its user growth is faster than the internet, much faster. So just sit back, relax on that one. All you really need to worry about is whether or not governments are corrupt and they'll spend more money than they make. And guess what? They certainly will. After that, we like Bitcoin. Peter Thiel just did a big speech actually predicting Bitcoin will outperform Ethereum and catch up to the market cap of gold. And that gold is going to catch up to the market cap of stocks because we're heading into a decade of inflation. The monetary system is broken. We'll see. I'm keeping a close eye on Bitcoin. Our high risk portfolio is all in on Ethereum for the growth asset, and it's going to add FNGU. FNGU is a bunch of the hottest tech companies, from chip manufacturers to, well, you've got NVIDIA, you've got Google, you've got Twitter, you've got Facebook, you've got Alibaba, Baidu, you've got all the really fast growing critical tech companies in FNGU. That's the new position we want to add to high risk if we see energy costs go down for a good reason. If we zoom in a little bit, let's see what the drawdowns have been for each asset. So we can see FNGU from the peak price is down 55, Polygon's down 53, Ethereum's down 26, Bitcoin's down 21. And again, we're expecting rates to fall from here and for these assets to rally much, much higher. Now, here's an interesting chart. You can see yellow are interest rates. In general, as interest rates rise, the green line, NRG, the top 10 oil and gas companies, leverage times 3 go up, and the NASDAQ goes down. But in this recent move, in the last 2 trading days, really, or last week, we've seen interest rates rise too quickly, and it's caused both the NRGU and NASDAQ to sell off simultaneously. The only inflation hedge working in the last 72 hours is our Boyle position. If we zoom out a bit, again, I'm expecting essentially rates to fall, that we've hit peak rates. So what worked for the last year is most likely to be the exact opposite of what will work for the coming year. This chart, we're comparing emerging markets to the SPY. Now, even though China is having some massive problems right now, in general, they have the economic engine that powers the entire world. And so our big general forecast for the coming decade is US is going to have to slow down its spending, and China is going to be able to increase its spending. It's going to give emerging markets a leg up, a weaker dollar, and a stronger return in emerging markets. So last time we had something like this was 2002 to 2008, and you got a 425% return out of emerging markets and only 75% return out of the SPY. And so we'll see if this starts to shapen up here. Since this point in time where emerging markets peaked, the S&P 500 is up 12 while emerging markets are down 23. This is a large position in our safe growth strategy where we play Asia, Europe, and US for a globally diversified stock portfolio. Now in this chart, we're trying to see if China is really going to start trying to make their stock market go up, basically. And what we want to see is Alibaba and Tencent outperform Taiwan Semiconductors. And they're finally starting to do that. We're also seeing them massively print money. That's what's really been crushing emerging markets, has been China's lockdowns. Here's a look at the European index we're playing, EFO. Nearly regained the conflict losses. So we've got an important ECB, European Central Bank announcement this week. But in general, the European economy has been really messed up from this conflict. And they're going to have to really print a lot of money, borrow a lot of money with the government's debt increases. And this tends to make stocks go up. So we remain bullish on Europe at very, very cheap valuations. Now, these are the alternative inflation hedges. These tend to protect tech stocks from eroding profit margins. So, for example, lithium has gone up year over year about 300%, and it's critical in batteries, especially for companies like Tesla. And cobalt, same thing for Apple for their batteries. So in the safe growth strategy, we're long REMX, rare earth metals, instead of copper miners. and we're long uranium, URA. So we can see the relative returns. They're all very similar, very correlated. But we see a greater shortage in lithium and cobalt over the next 3-year stretch compared to copper. And there will be shortages of copper as well. Here's the gold and silver chart. Are we on the verge of a breakout higher in gold and silver? Or are we in a reflation play this year? Hard to tell. Carefully monitoring it and thinking about a small silver position for the safe growth strategy and maybe for the high risk. So far, I haven't pulled the trigger. Generally, because I see 10 million jobs open with 5 million people looking for jobs. So I think we're going to see relatively strong economy over the remainder of the year in the US. Here's the core inflation data at 6.4. I believe this will print no higher than 7 tomorrow, and then it will start to fall. Now, the speed it falls will be critical for the bond market. If it's going to stay between 6.5 and 7 for the remainder of the year, markets are going to have tremendous problems. If it falls to the target of 4 by the end of the year, I think we're going to have a very, very happy stock market and cryptocurrency market with falling bond yields. And so the wild card is really the energy costs need to go down. So how long will the conflict in Europe last is most likely how long this inflation data is going to be sticky. Now we're already getting oil to sell off, and this is due to China locking down 200 million people. So I believe if we do get essentially some sort of diplomacy within the next 60 days, could be very, very bullish for markets, the stock market and cryptocurrency markets. Okay, here's the jobs rolling in consistently. We're still 3 million jobs short of where we were before the lockdowns. So I still think a lot of jobs can come online and keep the economy trucking along here. Bank credit continues to grow. There's no shortage of bank credit growing, and consumers are borrowing on their credit cards. So this is leading to increased retail sales, healthy earnings for corporations, and record highs in consumer spending. We're not seeing that big crash in the consumer yet. Balance of trade, highly negative, record levels. We're importing more than we export. We're not seeing a housing crash at these elevated interest rates. So we're not seeing the signs for an immediate crash. China's PMI went below 50. They're printing like a maniac as expected. And their exports do remain strong, but we should expect a slowdown due to China locking down 200 million people unexpectedly. Okay, so 2016 to 2018, the balance sheet was flat. They did rate hikes. Stocks and Bitcoin loved it. Then they started to try to sell off treasuries, and you ended up with a crisis that led to massive money printing. So now they're talking about doing the sell-off of the balance sheet and aggressive rate hikes simultaneously ahead of a dramatically slowing down economy. So will they really do it? We'll see come May. Okay, very good. So that is our look at the markets. I'm going to go ahead and break down exact asset allocation strategies. But I'm afraid if you're not upgraded, you're going to miss out. You're not going to see the exact trade alert until you call Dean at 505-322-7515 and upgrade that free trial. Okay, and real quickly, I will answer questions in the chat box before I go into exact asset allocation. Yao says, I didn't do the Boyle trade. It's up 140%. Should I get in now? Well, I always tell you the same thing, Yao. Follow the trading plan without exception. Okay, John says you're confident dropping 50% of Boyle for TMF was proper, right? Yes, absolutely. We're going to get ready to sell the rest of Boyle and most likely double TMF very soon, John. Tom says, what do you expect Boyle to do during the next month? I'm afraid it's going to go higher. It depends on how nasty the war gets. Stephen says, how much of the China story is related to Cygnus versus just trying to create chaos. I don't know. I do know the propaganda that freaked out the world came from China last time, tricked the hell out of me, felt like a fool. So I'm very skeptical. I believe this war in Europe is completely planned, total BS. The war could have been ended before it started, but this Zelensky fellow wants to sacrifice his people for foreign interests, is my opinion on that. So it looks like everything we're seeing is all planned, and the game seems to be inflation. Bill Bird says, I'm fairly new as a lifetime member. Yeah, Bill, it's not the percent, it's the ratio of shares. So you want to go into it, punch in your money, and then do what it tells you. The percentages go up and down all the time. The ratio doesn't. We all trade a ratio of shares so that we don't have to sit there and monkey around with the positions constantly. So I'm not targeting a percentage, I'm targeting a ratio of shares. So definitely use a calculator. Tom has a crypto-friendly bank in Wyoming. I need to check out. I'm going to save that. Or will you do me a favor, Tom? Email me that one, because these banks are still giving us a hard time for Rebel. Okay, great. So that covers some. Let's see if we got any new questions. John says, yeah, just send people to the homepage, John, and they can take a free trial, portfoliobuilder.io. Some people are wishing we were all in on Boyle and hadn't sold half yet. Yeah, it's like the only thing going up, huh? Okay, very good. Okay, I'm going to stop the free recording. We'll go to paid content now.